and welcome to BVTV. I'm Veronique Chapplow, Investment Specialist in M&G's Equities team. Today will be an equity market special focusing on the banking sector, specifically looking at the differences between American and European banks. 10 years after the collapse of Lehman Brothers and the dramatic sell-off that affected the whole US financial system, few would have imagined that US banks would come back from the crisis stronger than ever. That's in sharp contrast to European banks, which have been struggling with poor profitability, battling with the European debt crisis, and losing market share against their US and Chinese rivals. I'm delighted to be joined by Ed Booth, equity banking analyst at M&G, to discuss this topic. Ed, can you tell us why US banks managed to recover from the crisis much quicker and much better than their European counterparts?
Well, I think it's useful to look at historical context. So we all know that the US had a worse, or was the epicenter of the crisis, and that it then took its medicine quite early. And if we look at bank EPS, or earnings per share, in the US over that period, you would see that the banks very quickly turned quite loss-making. They recapitalized during that period. They wrote off a lot of bad debt. The economy delevered. And that allowed the economy to recover earlier than in Europe and return to trend growth. And when that happened, the US banks returned to profitability and grew gently. And then in the more recent period, when we've finally had interest rate rises in the US, actually that EPS growth has accelerated with the Trump tax reform as well. Europe, by contrast, was slower to reform. It was slower to deleverage, and the banks were also much slower to recapitalize overall. And so you see a picture where European earnings per share have struggled to recover. We're actually still 60% below where we were in 2007 for European bank earnings per share, in contrast to the US that's finally recovered to where it was in 2007. And what that nets to is a banking system in Europe where return on equity is around 9%. That's a reasonable recovery. But the US banks are earning a mid-teens return on equity, and that allows them to compound faster. They're able to grow their loans more quickly, and at the same time, they're returning very substantial amounts of cash to shareholders.
So where does that leave us with European banks? Is it still all doom and gloom? Can we see any sign of positive signals ahead?
Well, there are some positives. So the first of those is valuation. The European banks have actually derated about 10% year to date relative to the US, as we've worried about Italy and Turkey and so on. And regardless of how you look at it, on price earnings, the European banks are at least 20% cheaper than in the US. So that's one positive. Another is interest rates. We know that rates in the US have risen more quickly than they have in Europe, and that's helped bank earnings. If we look further out the curve, then, and take an average Eurozone economy like France, let's say, then you'll find that 5-year rates are still roughly around zero, in contrast to the US, nearly 300 basis points or 3% higher than than in France or another European country. And that tells you how differently people are seeing the two economies. If those rates in Europe were to rise by 1%, let's say, across the curve, then that would be worth at least 15% to EPS for the average European bank. And that's on top of the depressed valuation that we talked about earlier. The final positive is loan growth. The European banks have struggled for loan growth for quite some time, but it's been gently improving, and we're now up to 2.5% loan growth for the European bank in aggregate. That's weaker than the US. The US actually recovered to about 8% loan growth, and that's since slowed to around 5%. But you can see, therefore, that the systems are growing more similarly. I think the final point to make on this, though, is that if you take a step back, Europe's still in a tougher spot. So we have the Italian budget this week, and we're hoping that positive news would be a budget deficit of around 2%. If you take a step back and think about that, that's in an economy with 130% sovereign debt to GDP, 9 years after the trough of the crisis. And so you can see that the good news we're talking about is actually somewhat more complicated from a medium-term perspective. And I think that's why, for the average European bank, we're probably talking about a relative value opportunity at this point, rather than the compounding that I talked about earlier in the US.
So you touched on Italy. What if political uncertainties drag on and interest rate rises in Europe get delayed? Are European banks dead money in that scenario?
The truth is that the European economy that we talk about is actually a series of different economies with different banking systems. And so we talked about Italy earlier. We could have talked about Spain and Ireland, which also had a bad crisis, but they reformed their economy. The economy's returned to growth. The banks have recapitalized. The problem there is that consumers are still deleveraging, and therefore the banks are struggling for growth. We could also have talked about Sweden, and Sweden's household debt to GDP has actually made new highs pretty much every year since the crisis happened. And so if we look a bit deeper, we can find some opportunities. If I look, for example, in Central and Eastern Europe, then you can find economies that are growing pretty strongly today. They're benefiting from the reform that's happened in the Eurozone and the nearshoring that's happening, that's driving investment towards CEE. And those economies are therefore seeing better investment, and that drives loan growth in banking systems that already have better ROEs, not least because in places like the Czech Republic, rates have actually risen quite smartly off the zero bound already. Another place to look would be to look at the individual better deposit franchises in different countries. Quite often, if you look at the best deposit franchises, you can find a bank that also sells mutual funds and life insurance to its customers. And that means that although the bank may not be growing its loans, it's still growing its revenues because it's able to grow from the overall customer relationship. And in both cases, those banks tend to have higher interest rate sensitivity than that 15% European average. So I think if you invest thoughtfully, you can find places in Europe where there are compounding stocks that also benefit more than the European average when rates finally, hopefully, rise.
Thank you very much, Ed. On to the week ahead. Early in the week, we'll be taking the pulse of business confidence in Germany and consumer confidence in the US. All eyes will be on the Fed on Wednesday, with the market anticipating a 25 basis point hikes in US interest rates. Later in the week, we'll get a sense for the Chinese slowdown with the release of industrial profit figures and September PMIs. Finally, on Friday, we'll get the latest prints of inflation and retail sales for Japan. That's all for today. Thank you very much for tuning in. We'll see you back here next week.